With no full year budget or stopgap deal in place, the U.S. government could shut down at 12:01 Eastern on October 1st. But if you think the stock market is bracing for chaos, think again. Betting markets now place the odds of a Wednesday government shutdown starting at as high as 65%. Looking at the last 11 U.S. government shutdowns, the S&P 500, as tracked by the Vanguard ETF VOO, actually posted gains in 8 of them. So 8 of 11, it was positive, rising an average of 1.46% across a 7-session window surrounding the events. So on the surface here, it looks bad, particularly because there's basically two sides bickering with one another. But if you actually just kind of strip the noise out and look at the performance, it's actually better than expected here. That's a 72% win rate during periods where most headlines scream catastrophic. And I think this is one thing that we should really kind of stay on top of here. We do a really good job of kind of synthesizing and reducing noise, I feel like. And I feel like this is just another case where we need to keep doing that. The historical record is clear. Shutdowns don't always spook Wall Street. Take the longest government shutdown in modern history, which ran from December of 2018 to January of 2019. During that stretch, the S&P 500 soared 11.92%, driven more by a rebound from oversold conditions than any fiscal alarm bells. In October of 2013, the S&P 500 climbed 2.65% during a 16-day shutdown, defying expectations of a market sell-off. The 1995 to 96 dual shutdown saga also saw positive momentum, with gains of 1.2 and 1.89% recorded during the two separate episodes. Only in October of 1990 did the markets truly stumble, with the index falling 3.57% amid broader recession fears unrelated to the shutdown itself. Of course, not every shutdown has sparked a rally, but the data shows no consistent pattern of market crashes. And I think that's going to be the key here. Using the data that we have, which is the best really indicator that we have of previous performance, it's not as bad as people think, and it certainly has no consistent pattern of crashes. So keep that in mind. Now, that's not a guarantee that we're going to trade up here, but it should set the stage and give you a little context for what we're looking at here today. The market's resilience doesn't mean that there are no economic consequences. According to Goldman Sachs economist Alec Phillips and Ronnie Walker, a shutdown starting on October 1st would likely result in the furlough of around 900,000 federal employees, or approximately 40% of the workforce, with delayed paychecks and interrupted services. However, Social Security checks and tax collections would continue. Goldman estimates the direct impact of furloughs would trim 0.15 percentage points off fourth quarter real GDP during the week, with a likely rebound in the first quarter of 2026 once operations resume. You know, part of me wonders if the government shut down, if they just didn't collect taxes during that period. Part of me wonders if we'd ever see a shutdown. Just some food for thought there. I don't have an answer for you. The impact on employment data may be more psychological than real. If furloughed workers are improperly classified as unemployed, the jobless rate could tick up 1 to 2 percentage points, according to historical patterns. A shutdown would also delay key economic data, including the October employment report, scheduled for release on October 3rd this week. If the shutdown stretches into mid-October or beyond, reports due in November may also be impacted. So that, I think, is the interesting cog in the wheel here, if you will, on the shutdown. And, you know, I'm not sure what that means for long-term prices at this time. Markets are forward-looking, and while shutdowns can dent short-term economic performance, they rarely trigger full-blown sell-offs. As the clock winds towards October 1st, history suggests investors might want to tune out the noise and watch what the S&P 500 actually does, not what the headlines predict. And this is exactly what I want to leave you folks with. I think Piero here, who's one of our better writers, literally hits this right on the nail. We're active. We're going to be there. We got Brandy here on vacation looking at the market. So all of us have just kind of a heightened awareness of what's going on. And I think right there, that gives us an advantage. So trade what you see in front of you, not what the headlines are telling you. I think that's a pretty good piece of advice here.